Hello, this is Quent Bilo. I want to give a very brief introduction. In Principles 1, we primarily focused on sole proprietorships. This course will primarily focus on corporations, and the main difference is the owner's equity section of the accounting equation here. Assets equals liabilities plus owner's equity. In a sole proprietorship, there's only one permanent account, that is owner capital. All temporary accounts, expenses, and revenues were closed into owner capital through an income summary account. Investments go directly to owner capital, and any takeaways, withdrawals, are directly deducted from owner capital. The point is that there's only one permanent account for sole proprietorship in this area called owner capital that appears on the balance sheet. When it comes to a corporation, we'll call it stockholders' equity, and we'll find that there's multiple permanent accounts in stockholders' equity. In fact, there are three sections of permanent accounts. First section is a paid-in capital, various accounts. We're talking par value and value of common stock in excess of par value, earned capital, which is called retained earnings, and treasury stock, as applicable, is a deduct in this area. Here's an example of a corporation stockholder equity section. These are, again, permanent accounts only, very complex compared to only one account in a sole proprietorship. So in the first section, we have paid-in capital, which comprises all of the par value of common or preferred stock and values in excess of par value. If a corporation only has one type of stock, it'll be common stock. Preferred stock is optional. The paid-in capital section, also called contributed capital, is what the owners invest. Ownership in a corporation is evidenced by the issuance of common stock or preferred stock to the owners. The second section, retained earnings, is earned capital. This is the result of revenues over expenses coming into retained earnings as close to an income summary account and reduced by any withdrawals by the owners called dividends for corporations. So retained earnings, a permanent account, is a summary of all the revenues, expenses, minus the withdrawal or dividends paid periodically to stockholders. There's a subtotal on paid-in capital and retained earnings called total paid-in capital and retained earnings. And the final section, treasury stock, when applicable, corporations can purchase their own stock off the market and reduce the ownership. That becomes a reduction in the stockholder equity section. Paid-in capital and retained earnings, normal balances are credit. Normal balance of the treasury stock line, when applicable, is a debit or a reduction of the ownership of a corporation. So as an introduction to Principles 2, you need to familiarize yourself with this complex and expanded stockholders' equity section, taking the time to understand where all the numbers come from. In that paid-in capital section, remember the distinction between par value of common or preferred stock. It's just a number. Par value is not the value that stock is issued at. Market value is a combination of par value plus the additional paid-in capital or excess of par value. So the capital stock portion and the additional paid-in capital represent what owners paid in terms of market share for the stock they acquired. This expanded section is in corporations exist because of primarily legal requirements. Corporations can only pay dividends out of earned retained earnings. They cannot pay dividends out of paid-in capital on an ongoing basis. So therefore, there's a need to distinguish earned capital from contributed capital. At this time, I'm not going to comment on the common stock dividends distributable line of $50,000. This is an account that will morph into the common stock value when a stock dividend, upon declaration, that account is established. Upon payment of the stock dividend or issuance of the stock, that account goes away and becomes a part of the common stock line. More about that later.